And a warm welcome to another edition of Econoday Unplugged. It's Tuesday, the 20th December 2022. Terry Sheehan is on the US East Coast, Max Sarto is in British Columbia, and I'm Jeremy Hawkins in London. Well, over the last couple of weeks or so, we've had policy announcements from central banks in Australia, Canada, the Eurozone, India, Japan, Norway, Switzerland, Taiwan, the UK, and the US. And with the exception of Japan, which we'll talk about shortly, in all cases, the latest rate increase was less than that seen either at the previous meeting or at least earlier in the year. However, hand in hand with smaller rate rises, the same central banks have seemingly gone out of their way to signal that there are more on the way. So, at most, recent actions would seem to constitute just the beginning of the end of a tightening cycle and should certainly not be seen as a precursor to actual cuts. In today's podcast, then, we'll have a look at how much further rates might have to rise and indeed how much of a risk there is now that global policy tightening is taken too far. So, as usual, let's kick off with Terry. So, Terry, I guess it's tempting to say after last week's news that sort of Fed gave away with one hand, but clawed much of it back with the other. 50 basis point hike down from 75 basis points previously, but Chair Powell seemingly very keen to emphasise there's a way to go yet, and financial markets were clearly disappointed, especially after the soft November CPI. So first question, I guess, is why not stick with 75 basis points or simply sound less hawkish?
Well, I think it comes down to the fact that they had 475 basis point rate hikes in the pipeline, and they want to wait and see what some of those lagged effects are from that.
So they're obviously taking more on board now, are they? The fact, as you mentioned, we've had a fair amount of tightening so far. But I
hmm
guess I guess if we look at some of the numbers and kind of if I can do, I'd like to talk about the November CPI. Now,
Sure.
just to mention the numbers, I remember rightly, what it's 7.1% on the year, down from 7.7, and the market was expecting about 7.3. So, hey, the bond market loved it, and everyone thought, well, this is it. The Fed's definitely going to do only 50 rather than 75. But I'm sure you look at this. The Atlanta Fed produces sticky inflation measure, which just
hmm
looks at that part of the basket where, quite simply, the prices don't tend to be as volatile and tend to follow more of a trend. As if I read it correctly, it was up at 6.6% in November, up a tick from last time round, and the core rate was up a tick as well at 6.5 from 6.4. So, do you think it's the case that when it actually comes down to, how do you put it, sort of the underlying, that in actual fact inflation is still a problem in the States?
Well, the thing that Powell talked about was three types of inflation. Um, they've seen reduced inflation in housing. They've seen reduced inflation for some commodities. But where inflation looks sticky to him is in non-housing services.
Hmm.
And their price increases have remained stubbornly elevated. So I think that is where the Fed is focused right now, not those more volatile commodities prices, not the slowdown in the housing sector that they have very definitely seen in the last few months, but that other substantial part of the price picture that just isn't coming down as quickly as they would have hoped.
So does that really mean as we sort of start moving through into 2023 and beyond, investors need to be perhaps a little bit more selective at which part of the consumer price index they should be tracking with regards to Fed policy?
I think so. We'll get the PCE deflator, their preferred measure, later this week, uh, which is a little more comprehensive than the CPI
Hmm.
in terms of what it covers. But the fact of the matter is, we've sort of seen a false dawn in an improvement in inflation before, back in the summer months.
Right.
And I think the Fed is just being extremely careful to make sure that this is sustained and sustainable.
All right. Let me ask you about the labour market, because we talked about it umpteen times, I guess, on the podcast during the course of this year. November employment data, I think it's fair to say, was surprisingly strong, perhaps indeed potentially inflationary. I mean, is that something that the Fed perhaps isn't quite so worried about now, the fact that they reduced the magnitude of the tightening, or is that still something very much that they're keeping their eye on?
They're still keeping their eye on it. I mean, the picture in the labor market could change quite quickly. But for the moment, at least, they can still point to plentiful job openings, even if they're not as numerous as they were before. We have an unemployment rate that is enviable in most expansionary economies.
Mm-hmm.
There is no sign yet of a pickup in layoff activity. Businesses are holding on to the workers they've got. We still have a smaller labor force than we did pre-pandemic for lots of demographic reasons. So this is just something that, although the Fed will monitor it very carefully, it's just right now the labor market continues to look pretty tight.
Okay, in regards to that, I mean, looking at the Fed dot plot, which investors and financial markets get so excited about, although we had this, smaller increase in interest rates as we keep prattling on about, we've seen at least the median forecast being hiked. So it now would presumably mean that interest rates are expected to level out when they finally peak at a higher level than previously. Do you think? Well, the question is, how you sort of send a message to the market whereby, on the one hand, look, we're not tightening as much as we used to, which means that investors will start thinking, well, this is the start of reducing interest rate hikes and hooray, ultimately an interest rate cut, versus the fact that, oh, by the way, interest rates are going to be higher now than when we last rose hiked rates for 75 basis points. How do you think you're supposed to sell that to investors?
Well, I think that the Fed tries to distance itself from setting policy based on what the market is expecting. They are, in fact, the ones trying to set up the narrative about what the market should be looking for. Right now, the Fed is trying to set expectations that policy is going to be more restrictive for longer than it has been. And that's her story, and they're sticking to it for now.
Okay, so next year, how much further do you think interest rates, Fed funds will have to be hiked before the Fed decides enough's enough?
Tough call, but I'm thinking we're probably going to see 3 more 25 basis point hikes spread out over the next year.
Okay, and also I've got to ask you, I mean, markets, forecasters, analysts, call them what you will, they're still very split at the moment on whether or not we're going to see a recession in the States next year. What's your bet?
Oh, it's going to be a knife edge whether we slip into recession or not. Right now, I think we can avoid it. But if the global economy goes into recession that's deeper than anticipated, if there's some exogenous event that gives us another market shock, then we could easily slip into recession.
I suppose my last question I want to ask in terms of policy. I know you wrote a piece looking at the new members coming in and those leaving the FOMC voting side next year. The composition of the FOMC itself in 2023, do you think that increases or reduces the likelihood, or the risk perhaps I should say, of Fed policy being tightened too far?
I think it reduces it. I think the incoming voters are a little more sensitive to any deterioration in the labor market. And I think they're going to be more cautious about waiting for the economic data and the lagged effects of previous rate hikes to come through.
Okay, fair enough. Anything else you would like to put in for the last podcast before Christmas?
Well, we're coming toward the end of the fourth quarter, 2022, and so far the very early forecasts say that it looks like it's going to be a very slight positive quarter for the US. So that would be ending the year on a good note.
Excellent. That's what we want to hear. Okay, great. Thanks, Terry. Brilliant.
Welcome.
Right then, let's just move across to Max and Canada if we can. Max, where are we? December the 7th, Bank of Canada. Another 50 basis points up to 4.25% on their benchmark rate, which is as expected. Followed 50 basis points in October, but down from the 75 basis points in September. Are we getting towards the end of interest rate hikes in Canada?
I think so. We're definitely getting close to the end of it, and maybe pausing the January meeting or another 25 basis point hike. But we also have to take a look at the upside because it's hard to forecast what's going to happen to the energy commodity markets and
Sure.
international supply management. So as the governor said, the risk is greater if they don't tighten enough. So he's saying he would rather over tighten than under tighten.
I thought there's something interesting. Well, something almost what he didn't say in the last statement. When I just quote some of it, he said, "We are considering." I can almost stick an "only" in front of that, but we are considering the need for additional hikes to combat inflation. Whereas previously, effectively, they'd come out and intimated that interest rates were going to go up again. But it was interesting, I thought, that he also said that we got what mounting evidence that tighter monetary policies restraining domestic demand, and saying that the all three measures of the core inflation rates are starting to fall now. And yet, to quote again, inflation remains excessive and short-term inflation expectations remain elevated. So if you kind of knit all that little lot together, and it smacks to me a little bit like the Bank of England at the moment, whereby the economic outlook is so uncertain that they are actually themselves not very confident in terms of what they're going to do being the right thing.
Judging from the comments by the governor and deputy governor Kuzuki, they obviously want people to suffer a little bit, higher mortgage rates, so they have to give up on buying stuff or spending money on traveling or leisure. So through that channel, they're hoping that overall demand will cool off a bit and supply will catch up more to be in a balancing mode. So I think they do. I mean, higher rates going to punish people trying to buy their home first time. But I guess overall, they do want to see people shift some money and don't spend too much. So that's their strategy, obviously. So that means they will have to go meeting by meeting and take a look at the inflation, not just the total, but some core measures. And as you mentioned, they're not really happy with the what the data is showing yet.
And I guess that's one of the key questions, isn't it? I mean, facing all the central banks at the moment, how much will this widely assumed slowdown in most of G7, G20 economies will pull inflation down of its own accord, and how much the central banks still need to tighten? So I'm just quickly ask you about, before we moved on to Japan, about the Canadian economy at the moment. I think it was today what we had the October retail sales out, which of course in normal terms, I say of course, I mean normal terms it looked good, up 1.4% on the month, but only flat when we look at it in volume terms. I noticed that StatCan are overly optimistic about November. So where do you think the Canadian economy actually stands in the middle of this at the moment?
As the Bank of Canada forecast, we're getting close to flat growth, which can be a slight positive or slight negative for the coming quarters. And that's not really a bad thing. Both the US and Canada, judging from all the comments by the policymakers and business people, nobody seems to predict a huge slump coming up. So I think at this point in time, it's not very concerning, but at the same time, the governor of the Bank of Canada has been saying it's a very narrow window about whether they could actually go for a soft landing or not.
Okay, fair enough. Thanks, Max. Now, before I let you go, I know you're going to be really excited about this because I've been asking about the BOJ, Bank of Japan, every month for all this year. And each time you come back and say, well, there's nothing going on. And yet today we finally got something. So perhaps you can tell us what the Bank of Japan actually said today in a mini statement. And it clearly came as a surprise to financial markets. So you can enlighten us in terms of perhaps what it also means for policy going forward as well.
Right. So what really happened was not a rate hike. Target rates are still minus 0.1 for the overnight rate, and around 0% for the 10-year bond yield. They just expanded the range for trading in the 10-year JGBs. It was between minus 0.25 to plus 0.25. Now it's double, minus 0.5 to plus 0.5.
Right. First question. I'm interrupting already, I know, but why? Why now?
Why now? I think my guess is the operation team thought maybe they could tide over. Since they said early spring, that means around March when the Bank of Canada, Fed, everybody started raising rates, and that added upward pressure on Japan's yields too. But so that it's really not a natural condition in Japan. The Bank of Japan saying in the future economy is going to recover. So that means it is natural for the markets to expect a higher rates. But artificially, bank has been pressing the both short and long end too to make the yield curve so flat. That's part of their long-held policy stance. So that means it was getting harder and harder for the operation team to keep the top end at 0.25 for moments. The market went above that level. So maybe it was a matter of time that they would have to expand the range anyway. And
sorry, I was going to say, do you think now by doing what they've done, and we saw yields clearly climb very sharply in the way the market interpreted what the BOJ was saying, do you think now it's a case that they're going to start, perhaps stabilizing close to this 0.5% in the same way before they're at the top of the range around 0.25%?
It's going to be hard to fight the market forces, I think, even though Bank of Japan can print as much money as they want.
Right.
So what's going to happen is it's going to be a race, like a battle between the Bank of Japan and markets. If the market forces want to test the upside further and further, the bank may end up expanding the band more. But the point is here, the bigger picture is the January 2013 agreement between the government and the BOJ, which was to defeat deflation completely and boost Japan's growth potential. And for that, BOJ has been adding cash to the markets for almost 10 years through massive monetary easing, and that's done. And the government is responsible for implementing a flexible fiscal policy, which is to add stimulus when it's needed, but try to cut back on the long-term debt, which is sort of half done. And the third, I think, is the most important part of the package was to help boost the economy's growth potential, helping growth-oriented industries or shift to labor. But that hasn't really happened, and right. I know it doesn't happen overnight. So my point is, unless you rewrite the agreement, that agreement put the BOJ in a very tight spot. They have to achieve 2% inflation, which was never achieved in Japan before, and not a stable 2%. So after 10 years of massive easing, it may be a time to change it, but nobody really wants to pick up anything that can be politically dangerous. So see if the prime ministers will be ready to change that without upsetting the markets.
Where we'll be without politics. Right, my last question for you. Mr. Kuroda finally stands down in April next year, does he not? Who's going to replace him, and will it have any implications for policy?
I think, as everybody guesses, Deputy Governor Governor Amamiya he's been supporting the governor on and off, and previously too, to work out a lot of really at the time called unconventional easing measures. So if he takes up the job of the governor, that's going to leave an impression that it's going to be in safe hand. On the other hand, another candidate is Amamiya's former colleague Nakaso. They're both Korea central bankers. Nakaso was more in charge of international issues and financial market supervision. So he can also relate to other central bank people. That can leave an image that BOJ will be in a safe hand and can coordinate with other central banks and international organizations. So either way, the prime minister is going to be all right. I mean, his reputation as picking the right person, but I'm not sure. Kuroda was from the MOF, Ministry of Finance originally, so maybe it would be all right with the Ministry of Finance, because in the past they alternately chose somebody from the ministry or the bank every 5 years. So I think myself think Amamiya will be a strong candidate, but again, for people who don't like 2% target or who don't like the current kind of a legacy of Abenomics package, that means still like unchanged BOJ. What's new about it? So that's really up to the Prime Minister's office, I think.
Okay, and my very last question for you. As you mentioned, the short-term interest rate is still pegged at a target rate at minus 0.1%. When does it finally go positive?
When?
When does it finally go positive? The short-term interest rate target has been minus 0.1% for such a long time now.
Right.
When do you think it might finally go above zero, or indeed even up to zero?
It's not a very popular policy because that really cuts financial institutions' margins. And if you remember the introduction of that policy, Kuroda had been saying, no, we're not going to introduce a negative interest rate policy. But then a few weeks later, he said, well, after talking to my colleagues in Europe, I thought it might be a good idea. So he was called a liar. So it's not a very good policy for that sake, but for the BOJ and agreement between the government, it has worked for them. But eventually, it has to end. And the timing, I'm not sure. If the BOJ sticks to the outlook that 2% inflation is not going to be achieved in a stable manner for the next 2 years, then could they argue still trying to achieve the target while changing the short-term interest rate target? And my guess is Amamiya is so good at crafting statements and justifying whatever the action they take. So it could happen next year, maybe later. But the whole point is, I think the more important point would be to see whether a 2% target is good for Japan, or should it be in a range, as I suggested a long time ago and repeatedly. It should be maybe like between instead of 1 to 3, maybe 0.5 to 2.5, or maybe a wider range, and then they can claim that, well, we're in the range. So that may be an idea. So then if that happens, then they can easily change the yield curve control target rates.
Okay, change the target. Brilliant. Okay, great. Thanks a lot for that, Max. Okay, then. Unfortunately, we don't have Brian today, but a few points should make from the countries he would normally cover. Certainly with regards for China anyway, which has really never been out of the media headlines during the course of 2022. Over the last month or so, we've had another cut in banks' reserve requirements, more help for the real estate sector, and a long last, it seems, at least the approaching end of the zero COVID policy. But quite clearly, investors are still very worried about the economic outlook. Excuse me, appears to be big concerns about rapidly rising COVID cases out in China now. And indeed, just out of interest in terms of looking at the overall performance of the Chinese economy, Econoday's ECDI, which looks at how recent economic data have been performing versus market expectations. Last week, that managed to hit a -100 reading, which is the lowest possible on the scale. So very much underlines the fact that the Chinese economy in general is underperforming at the moment. We've had in particular very weak and disappointing retail sales, industrial production, fixed investment all for November. So market forecasters revising down their expectations for fourth quarter GDP, and indeed looking at the government's forecast or target forecast growth of 5.5% as being further away than ever. Now, we haven't had a cut in the loan prime rate since August. And it would seem to be, I guess, that they're increasingly concerned about the potential effect of a cut in interest rates on the Chinese exchange rate, particularly given that the hawkish noises coming out the likes of the Fed, as Terry was talking about, ECB and so on elsewhere around the world. But nonetheless, it's quite clear that the Chinese economy is currently underperforming. We could well see another cut in reserve requirements, I expect, at some point, and that's still going to be a big issue or a big focus in terms of international economies as we move into 2023. Out of Australia, sticking with this theme of interest rate reductions, beginning of this month on the 6th, the RBA if only. The RBA rose interest rates by 25 basis points, up to 3.1%. That was as expected, but it followed the reduced pace of tightening in October, and that came after 5 meetings worth of 50 basis point increases. Even so, there was apparently, from what the minutes told us earlier on this week, there was an extended discussion on whether rates should be increased by 50 or 25 basis points. Clearly, the 25 basis point camp won, but nonetheless, the fact that there's still such uncertainty about the magnitude of the interest rate changes fits in with this idea that anyone thinking that we're about to see interest rate cuts coming out of some of these countries is still fairly wide of the mark. Indeed, the November labour force survey we had out last week was much stronger than expected, and that might even play into the hands of those RBA members who wanted to see the 50 basis point hike. So as far as the Australia is concerned, interest rates may be coming down, but if they come down again and come down very slowly, and there's at least an outside risk, we might have to see rates going up again. Somewhere where interest rates are coming down more slowly than elsewhere is certainly the Reserve Bank of New Zealand. Their last meeting was back on November the 23rd. But at that point, they raised their official cash rate, up by 75 basis points to 4.25%. So that was more than the 50 basis points we saw in the previous 5 meetings. So there was clearly no indication of any kind of slowdown in the rate of increases in interest rates, or official interest rates, I should say, in that part of the world. Okay, through to Europe then. Well, ECB, as folks probably saw, they followed the pattern we saw coming out the likes of the Fed with reducing the magnitude of their interest rate. This was last Thursday, but all their key rates up by 50 basis points. So the benchmark deposit rate now stands at 2.0%. So that was down from the 75 basis points we saw in October, a record increase in itself. But as I say, very much a la Fed, really, in terms of the overall tone coming out of both the statement and in particular President Lagarde's press conference afterwards, very much hawkish. In fact, if you believe Bloomberg, more than a third of the ECB policymakers actually wanted another 75 basis point in the first place. And Lagarde really went out of her way to basically tell markets, well, look, don't expect another 50 basis point increase in February. And indeed, I guess probably another 50 basis points in March. While they're doing that, well, it comes down, I suppose, to their inflation forecasts. All these central banks, they've been struggling with above target inflation. And as of last week, they revised up both their overall CPI, or HICP as they call it, inflation forecast, and the core inflation forecasts, so that they're above target throughout effectively the entire horizon, including in 2025. So in other words, it looks as if at current levels, interest rates simply aren't high enough to meet their inflation goals. So do expect additional interest rates at the ECB in the beginning of next year. Futures contracts, which were expecting 3-month money rates in the Eurozone to peak right about 3.0% just before the meeting, are now looking for rates to top out closer to 3.5%. So they were certainly caught by surprise by what was coming out of the central bank, despite the fact we saw this smaller increase, which was widely anticipated. Should also mention, of note from last week's meeting, the ECB announced at least some details of what their quantitative tightening policy is going to look like for next year. So from March time, the asset purchase program, the old APP, that portfolio will be reduced at what they call a measured and predictable pace, by the bank refraining from reinvesting all the principal from its maturing securities. So the reduction is currently targeted at 15 billion euros a month. So that'll be about half the redemptions due to fall over the period until the end of the second quarter of next year, when they'll decide what sort of pace to shrink the balance sheet thereafter. Now, it's got to be noted that this really caught bond markets very much by surprise. There's been a lot of talk about quantitative tightening being discussed at this meeting and some kind of broad-based plan being released, but nonetheless, Milan Stock Exchange was down about 2.5% within a few minutes after this came out, and we've seen a sharp increase in bond yields right across the Eurozone, and spreads between the likes of Italian BTPs and German bunds have widened significantly. And if this continues, it may well be the case that we find that although quantitative tightening, according to the ECB, is not supposed to be a substitute for higher short-term interest rates, the dampening effect on the Eurozone economy from higher bond yields might actually lead to interest rates perhaps not going as high as markets currently anticipate, or at least they anticipate at the moment. What else we got? Again, on a big Thursday last week, Bank of England also came out following the Fed and the ECB. They increased interest rates by 50 basis points. So bank rate over here, the benchmark rate, stands at 3.5%. No surprises in that. But of note, a really clear indication of just how uncertain the MPC is about where the UK economy is going to go in 2023 and beyond. So there's a huge split on the MPC itself. We had 2 members wanting no change at all, 6 wanting the 50 basis point increase, and 1 wanting a full 75 basis points. And I must say, as long as I've been in the business, I can't remember seeing the split being as wide as that. And it really does, I guess, suggest that securing large interest rate rises in the future will become, that much more difficult to achieve. Money markets are still effectively looking for short-term rates to peak around about 4.7% in September 2023. But it's going to be interesting, I think, as we move into next year. Most of the economics in the UK are looking pretty awful at the moment, one way or another. And I guess that we're going to see the kind of downward pressure on UK inflation stemming from domestic economic developments over here being rather more marked than we're going to see, certainly across most of Europe, perhaps in the States and in Japan as well. And we could well see perhaps this slowdown in the economy, indeed, widely expected recession, leading to a faster slowdown in perhaps even core inflation, crucially for the Bank of England, than currently anticipated. And if that's the case, it may be that bank rate over here tops out a little bit lower than markets are currently anticipating. To round off quickly with the last one from Europe from last week, the Swiss National Bank again announcing on Thursday. What can we say about their monetary policy assessment? Well, for a start, it confirmed that the bank is contented with the current levels of the Swiss franc. That's no big surprise. The SNB indeed has been shrinking its balance sheet quite rapidly in recent weeks, despite what was previously perceived to be a strong Swiss franc. However, the policy rate was still hiked by 50 basis points up to 1.0%. So again, in line with the other central banks, that was, although it was as expected, it was down from the 75 basis point hike we saw in September. And that with inflation running at just 3.0%, how many central banks would like to see that at the moment, and a core rate of only 1.9%. So why did they hike anyway? Well, as we talked before in the podcast, the Swiss National Bank is certainly amongst the most anti-inflation of all the major central banks, and their updated forecasts show inflation above their pseudo 2% target right through the new forecast, and indeed crucially rising in 2025. So it looks as if the overall tone of what they came out with was hawkish, simply because they're not prepared to accept inflation remaining above target, perhaps as long as some of the other central banks are going to. Financial markets were expecting rates, 3-month money rates, to peak at about 1.3% at the time of the last MPA. Well, now they've increased that up to 1.6%. So almost certainly more central bank tightening to come out of the SNB. But it's got to be said, the real economy is also slowing down now. Most of the recent economic numbers have undershot expectations, including inflation. So for what it's worth, my best guess at the moment, we'll probably see a 25 basis point hike in March, and that may be it. In any event, I would guess that the policy rate for these SNB is closer to its terminal level than most other central banks currently. Right, that is my lot. Anybody else got anything they'd like to put into the pot before we end 2022?
I just wanted to mention that Prime Minister of Japan, his cabinet's approval ratings have been drifting lower and still staying low. And the latest controversy is the government decided to raise the defense spending over the next 5 years, and nations split between yes and no, but people don't like higher taxes for that. So it's going to be interesting what's going to happen to the government going into the New Year's.
Okay, great. Thanks, Max. I'll tell you what, Lou, if you think your government's got bad opinion poll ratings, you should try the UK at the moment. Anything else from you, Terry?
Nothing here, thanks.
Okay, well, that's it then. Let's just about end it there. Well, I guess key takeaway from recent central bank actions and comments is to recognise that in most cases, they're looking increasingly for second round effects. So headline inflation should fall in 2023, if only due to negative base effects from the commodity markets. But core rates will be potentially a lot stickier. So do keep an eye on underlying measures and those factors which influence them most, notably wages. If these stay elevated, key interest rates could well stay higher for longer than currently discounted. Actual rate cuts, they're not on the agenda yet, and that might just mean that monetary overkill for the real economy becomes that much more of a risk as we go through 2023. And on that note, on behalf of Terry, Max and myself, and indeed the whole Econoday team, thanks as always for listening. Have a great Christmas, and we'll be back early in the new year. We'll look at what's likely to be shaping economies and financial markets as we go through 2023. And of course, in the interim, don't forget you can keep up to date with all the key indicators and events over the holiday period in Econoday's global economic calendar. Look forward to seeing you again next year. Bye for now. Strategic investing and analysis are a lot easier when you can identify patterns and see how economic events and announcements correlate with specific market movements. The Econoday Investors Journal provides a convenient and easy way to follow important economic events every day, every month throughout the year. View the most important market-moving events for the upcoming year in a glance. The Econoday Investors Journal is your essential desktop resource for economic events and indicators, FOMC meetings and announcements, US banking holidays, equity settlement dates, and more. The Econoday Investors Journal is much more than a financial calendar. It's an indispensable tool to help you anticipate active days in the market. Learn the intricacies and interactions of the market, record daily market activity, and explore helpful insights from experienced market analysts. Take advantage of our informative resource centre, which includes a comprehensive glossary of need-to-know terms, clear, concise information on policy and historical trends, useful graphs, and a guide to the influencing factors and people to watch at the Federal Reserve. Order your Econoday Investors Journal now at shop.econoday.com.